Money, money, money. Well. Looks like the Swiss authorities are causing some trouble in the financial world. In a recent move, they decided to impose full losses on certain bondholders of failed lender Credit Suisse. Yikes. And as you can imagine, this isn't sitting well with everyone. Not at all. In fact, Tidjane Thiam, the Institute's former CEO, wrote a column in the Financial Times warning that this decision will make life more difficult for European banks going forward. And you know what that means? More stress, more headaches, and more complaining about the boss at the water cooler. Yeah, not fun. So, what's the big deal? Well, apparently, the distressed sale to crosstown rival UBS upended international finance's traditional hierarchy. Instead of stock owners being the first to lose their shirts when a company fails, investors that bought $17 billion in so called additional Tier 1 bonds are taking a bath. Ouch. Thiam argues that this precedent could prove costly for lenders on the continent by further pushing up their funding costs. And we all know what happens when costs go up. Yep, you guessed it. More complaining about the boss at the water cooler. But wait, there's more. The market is already pricing in higher capital costs for European banks, and investors are pricing in added risk, with shares in German lender Deutsche Bank selling off hard on Friday. Oh boy, someone get the Tylenol. Yeah. So, why do banks even issue these additional Tier 1 securities, you ask? Well, they were created to make lenders more resilient without cutting off the supply of credit to the real economy. And I don't know about you, but I always love it when banks try to be resilient. It's like when your mom tells you to put on a jacket before you go outside. She's just trying to protect you from the big, bad world. Anyway, to achieve more robust levels of solvency, regulators wanted banks to build more powerful shock absorbers into their balance sheets. But issuing fresh common equity is costly. So they created AT1 bonds that would either be written off or automatically convert to loss absorbing common equity should a bank's solvency buffers be fully depleted. It's like a safety net, but for bankers. So what's the moral of the story? Well, if you're an investor, you might want to think twice before buying these risky AT1 bonds. And if you're a banker, get ready for some more stress and complaining about the boss at the water cooler. But hey, at least we can all laugh about it, right? Right? Anyone? Yeah. What do you think about this latest development? Let me know in the comments below as always, and don't forget to follow, thumbs up, like, and subscribe for more updates on the wild world of finance. Thanks for tuning in.